In Chapter 4, we looked at an introduction to debt instruments. We looked at things that were true basically for all bonds. In Chapter 5, we're going to look at the types of debt instruments. What will we be focusing on in Chapter 5? Well, some of the key topics. We're going to start with a discussion of Treasury securities, the T-bills, T-notes, T-bonds, and a couple of other different types of treasuries. And then we'll turn our attention briefly to the government agencies. We'll then look at municipal bonds. The two major types of municipal bonds are general obligation bonds, sometimes referred to as GO bonds, and revenue bonds. We'll look at the underwriting process. What does that mean? How do the bonds get from the issuer into the investor's hands? We'll then look at different types of corporate bonds. And the major distinction, some corporate debt is secured, meaning there's some specific asset that's been pledged, and some is unsecured. We'll look at this distinction. And then finally, we'll end with a discussion of money market instruments. Now, money market instruments, we'll see, are short-term debt obligations, generally a year or less. But let's begin with treasuries. So if we look at an overview of treasuries, treasuries are issued by the federal government, and they're backed by the full faith and credit of the U.S. government. So these are often said to have no credit risk. Sometimes when we look at comparing returns to a risk-free investment, a risk-free return, we use treasuries as the risk-free return. It's backed by the full faith and credit of the U.S. government. So the treasuries, T-bills, T-notes, and T-bonds are what we sometimes refer to as direct obligations of the U.S. government. The other reason people tend to flock to treasuries for safety is it's a very highly liquid market. Now, what does that mean? Liquidity is the ability to convert something into cash quickly at a reasonable price. Well, treasuries are a highly liquid market, meaning it's easy to get your money out. And that's one of the reasons that treasuries are sometimes a flight to safety. Not only no credit risk, but also the fact that it's a very big liquid market. Now, very important, on the right-hand side of the screen, the taxation of interest. The interest on treasuries is subject to federal taxes, so it's taxable at the federal level, but it's exempt from state and local taxes. So, if you buy a treasury, that interest you're getting will be subject to your federal taxes, which might be 28%, 31%, what have you, but it will be exempt from your state and local taxes, which are generally much lower than the federal taxes. Now, let's look at the specific types of treasuries. There's three main types: T-bills, T-notes, and T-bonds. On the next slide, we'll get into details about each one. But these are what are considered the marketable treasury securities. What that means is they can be traded in the secondary market. The Treasury does actually also issue some savings bonds that you may be familiar with that are sometimes referred to as non-marketable treasury securities. Now, the T-bonds and T-notes are interest-bearing securities. What we mean by that is they do pay semi-annual interest, like we looked at in the previous chapter. So the coupon, again, is stated as an annual percentage. So maybe it's a 4% coupon, which means it pays 4% a year. So on a $1,000 bond, that would be $40 a year. But it makes those payments semi-annually. So you don't get one $40 payment a year. You would get two $20 payments like we looked at in the previous chapter. So T-bonds and T-notes pay interest just like the bonds we looked at in Chapter 4. The T-bills, we'll see, do not pay any periodic interest. Instead, T-bills, we'll see, are issued at a discount and mature at face value. Now, let's compare the T-bills, T-notes, and T-bonds. First, make sure you know the different maturities. T-bills are issued with maturities of up to 1 year. Okay, T-bills are issued with maturities of up to 1 year. T-notes, maturities of 2 to 10 years, and T-bonds have maturities of over 10 years. Now, what is the minimum face value for a treasury? The minimum face value for a treasury is $100 and in multiples of 100 thereafter. Now, many times when they give you a number question on your actual exam, they may ask you to figure out the price based on $1,000 par value. Okay, but the minimum denomination is $100. Now, how are they issued? They're issued in book entry form. In book entry form. What does that mean? Book entry form means there's no physical certificate that's printed. Instead, you go on record as owning the bonds. So book entry, there's no physical certificate. Instead, you go on record as owning the bonds, notes, or bills. As we said, how do you get your interest? For the T-bills, they're issued at a discount, mature at face value. The difference is considered your interest. So they're issued at a discount, mature at face value, and the difference is considered your interest. So you might buy it for $980. At maturity, it pays par value of, let's say, $1,000. The $20 difference is considered your interest income, which would be subject to federal taxes, but exempt from your state and local taxes. What about the T-notes and T-bonds? As we said, that pays semi-annual interest just like any other bond we looked at in Chapter 4. So it might be stated annually, 4%. It pays $40 a year per $1,000, but you're getting that in two $20 payments. Now, when the bond trades in the secondary market, the buyer will pay the seller the price of the bond plus the accrued interest, which we mentioned in Chapter 4. When calculating the exact amount of accrued interest, the way they do it is they base it on actual number of days in each month, but 365 days in the year. So again, the reason for this accrued interest is come the next interest payment, the buyer of the bonds is going to get the whole 6-month interest payment. But they may not have held it that entire 6 months. So they pay the seller for the portion the seller deserves. And the seller deserves basically from that last interest payment date up to but not including the settlement date of the transaction. And when you calculate the exact number of days, it's based on actual number of days and 365 days in the year. Now, how are they initially sold by the government? They are sold in auctions. The T-bills are generally auctioned off weekly. The T-bills are generally auctioned off weekly, where the T-notes and T-bonds are sold at periodic auctions as announced by the government. Some of them are auctioned off quarterly, some different than that. So the T-bills generally auctioned off each week by the government, where the T-notes and T-bonds are generally auctioned off on a periodic basis as announced. Now, the pricing of the government securities. This we looked at in Chapter 4, so we're not going to do it all again. Just a quick reminder. The T-notes and the T-bonds and the agency securities like Ginnie Mae, Fannie Mae, Freddie Mac, which we'll touch on in a second, Those are quoted as a percentage of par in points and in 30 seconds of a point. And that was explained in Chapter 4, where we looked at the math. The T-bills are not quoted in 30 seconds of a point. Instead, they're quoted on a discounted yield basis. So the bid and the ask that we're looking at, 294 and 290, you can think of as more of a yield rather than a dollar price. And notice the bid is numerically higher than the ask here. Well, the bid is what the dealer is willing to buy it at. So do they really want to buy it for more than they want to sell it, which is what the ask is, what they're willing to sell it at? No, because these are yields, and it's what's called a discounted yield. So you can think of it to some extent like it's the discount off of the face value. It's the discount off of the face value. So the bid of 294 means they're looking to buy it at a 2.94% discount from its face value. A 2.94% discount off of its face value. Where the ask, what they're willing to sell it for, is only a 2.90% discount. So notice the ask, 2.90, is a smaller discount off of face value. That's actually the higher price. The bid, the bigger discount off of the face value, is the lower price. So the bid's higher yield actually represents the lower price. And this is the way T-bills are quoted, not the T-notes and T-bonds. Now, another type of treasury is a TIP. TIPS are Treasury inflation-protected securities. So how can Treasury investors protect themselves from inflation? Well, they could buy what are called TIPS, Treasury inflation-protected securities. And many people do call them by the acronym TIPS. Normally, high inflation will hurt bonds for two reasons. One, if you lock yourself into a 7% return or a 4% return or a 2% return, and inflation, which is prices going up, increases, that hurts what we sometimes refer to as your purchasing power, right? So if you buy a treasury yielding 4% or any bond yielding 4%, and inflation, meaning prices going up, is at 1%, then you're earning 4%, but prices are going up at 1% a year. So you're getting ahead of the game by 3% a year. That's what's sometimes referred to as your real rate of return. But what if inflation went up to 3%? You're earning 4%, but now inflation's at 3%, so you're only getting ahead of the game by 1% a year. So notice how that higher inflation hurt your real rate of return. What if inflation rates went to 5%? Now you're not even keeping up with inflation. Sure, you might be earning 4%, but prices are going up at a rate of 5% a year. So you actually have a negative real rate of return. So notice inflation hurts these fixed income securities. The other way inflation hurts fixed income securities is generally if inflation goes up, the Fed tightens and interest rates also go up. And remember, if interest rates go up, what happens to bond prices? They go down. So high inflation generally is bad for fixed income securities like bonds. Well, what is a TIP? A TIP has a stated coupon rate which will remain constant. So maybe you're getting a 4% coupon. That will remain your coupon rate, that 4%. But what happens is the principal is actually adjusted for the rate of inflation based on what is sometimes referred to as the CPI, or the Consumer Price Index. The CPI stands for the Consumer Price Index, which is a measurement of prices. So this is how we generally measure inflation, by looking at the Consumer Price Index. So what happens is your principal gets adjusted based on the rate of inflation. So let's take a look. So your original principal might have been $1,000. The coupon rate is 4%. So you would get 4% of $1,000 or $40 a year in interest payments. And then if the bond matured, you'd get $1,000, your principal back. But TIPS, we said the principal gets adjusted based on the inflation rate. So let's say that inflation increased at 1%. So your annual adjustment would be roughly $10, 1% of $1,000. So your principal would become $1,010. Notice the coupon rate doesn't change, it's still 4%. But 4% of $1,010 is $40.40. So notice your annual payment does actually go up. Now, if inflation went up at 2% the next year, then that principal would be adjusted from $1,010 up by 2%. So the principal gets adjusted for the rate of inflation. Then the coupon of, in this case, 4%, is multiplied by that new principal amount to give you your annual payment. Now, what will we get at maturity? We will get the adjusted principal, not just par value. So if at the end of holding this bond with all the adjustments, the principal is now $1,300, then we would get $1,300, not just $1,000. We get the adjusted principal. Now, what happens if there's deflation? And what does deflation mean? Deflation means prices are going down. Deflation means prices are going down. Will the principal be adjusted downward? The answer is yes, it will. So that your coupon would be multiplied by, again, that adjusted principal. And if there's deflation, the principal will be adjusted downward. However, at maturity, you will always get at least par value. So what the government pays at maturity is the greater of par value or the adjusted principal. Now, it's rare that we have deflation. So generally, you will get the greater amount, which will be that adjusted principal, which has been increased. Okay, but what they do pay is the greater of the adjusted principal or par value. And know that TIPS are one of the few types of bonds that would be attractive if inflation was going to go up, because notice the principal is being adjusted. Another type of treasury is treasury strips. Treasury strips. Now, the federal government actually does not issue treasury strips. Instead, they're actually created in the secondary market, that the broker-dealers and banks take a treasury, let's say they take a 10-year treasury note, and they say to the government, we want to separate out each payment that this 10-year treasury note is going to make. Remember, it's going to pay interest every 6 months, and then at that final maturity, it's going to make its last interest payment and the repayment of principal. And what they decide is, rather than selling and marketing the 10-year treasury note, we want to sell each individual payment as a separate security. So we're going to sell the 6-month payment as a security. And if you buy that, all you're going to get is that payment. We're going to sell that 1-year payment as a security. And if you buy that, all you'll get is that 1-year payment, that payment in a year. What about the principal in 10 years? We're selling that as a separate security. So what we create is a lot of different zero coupon instruments out of that one T note or T bond. STRIPS actually stands for Separate Trading of Registered Interest and Principal Security. Separate Trading of Registered Interest and Principal Securities. Although everybody just calls them STRIPS. So what it does is it considers each payment its own security and sells each one as a zero coupon instrument. So each one is sold at a discount, matures at face value, and the difference is considered your interest. So these are forms of zero coupon debt created from the Treasury notes and Treasury bonds. And notice, out of one 10-year Treasury note, we can create many different zero coupon instruments because we're treating each payment as its own security. And if you buy it at a discount, and all you'll get is that payment that's made in 5 years, 7 years, 9 years, whenever. The big thing to recognize on the test is when you see Treasury STRIPS, you know that this is a zero coupon Treasury. And remember, we looked at zero coupon instruments in Chapter 4, which you can go back and listen to if you need a refresher. They're issued at a discount, mature at face value. The difference is considered your interest. And what the advantage is they give you that locked-in return over that period of time. Now, how are the T-bills, T-notes, and T-bonds issued? As we stated, they are issued in an auction. Okay, they are issued in an auction. So the government sells treasuries through the periodic auctions, which for T-bills is generally weekly. For T-notes and T-bonds, it's as announced. Now, when they auction them off, they get competitive bids and non-competitive bids. The competitive bids are generally placed by the large financial institutions. And what they're indicating is the amount of treasuries they'll buy and the price or yield that they'll pay. So they are indicating both the quantity and the price or yield that they're willing to pay for the treasuries. Large financial institutions generally have to place their bids as competitive bids. But there's also non-competitive bids, which are often placed by the public, where they indicate only the quantity that they're willing to buy. So I'm willing to buy $10,000 worth of these T-bills or T-notes or T-bonds. But I don't indicate the price or yield. So you can think of it a little bit more like just a market order. Okay, I want to buy $10,000 worth of these T-bills, T-notes, T-bonds, whatever they're auctioning off. And what I'm going to get is the price that they come out at, which we'll talk a little bit more about in a second. So what they're indicating is only the quantity, and the bidder agrees to pay the lowest price or highest yield of the accepted competitive bids. So what they do is they sort of set these non-competitive bids aside. So you can think of it they are awarded first. So they're sort of awarded first, but we don't know the price until we look at the competitive bids. So they set them aside, then they look at the competitive bids, which determine the price. We'll look more at this in 1 second. But I want to say one more thing about the T-bill auctions. We said they're auctioned off weekly. A lot of times that's on Monday, sometimes it's on Tuesday. But most T-bills are auctioned off each Monday. When they're auctioned off, the T-bills that are auctioned, whether they're auctioned on Monday or Tuesday, the settlement for that new issue is on Thursday. So, unlike treasuries traded in the secondary market, when you buy a T-bill at the auction, whether it be the Monday or Tuesday auction, the settlement is on Thursday. When you trade treasuries in the secondary market, Later on in the program, we'll see that settlement would be next business day. That settlement would be the next business day when it's traded between two investors in the secondary market. However, when you buy the new T-bill at the auction, it settles on the Thursday of that week. Let's take a closer look at the numbers. Here we see we have an example of $100 million worth of bonds being offered at a 4.5% coupon. Now, what bids does the government receive? They receive $20 million worth of non-competitive bids, and then $40 million, and $30 million of competitive bids. Well, the $20 million of non-competitive bids are awarded first. They are set aside. They will be filled. We're just not sure what price they're going to be filled at. And non-competitive bids don't take up the whole auction because they do place limitations on the large institutions' ability to place non-competitive bids. They generally have to place competitive bids. So the $20 million of non-competitive bids are set aside. They'll get awarded, but we're not sure of the price yet. Well, what do they then do? Well, the government wants to sell it to whoever was willing to accept the lowest yield, or in other words, pay the highest price for the bonds. So at a yield of 4.90, they can sell another $40 million worth of the bonds. But they're auctioning off $100 million worth of bonds. So 40 plus 20 is only $60 million. So they have to go to the next best bid, okay, where at a yield of 5%, so that would be a slightly lower price, okay, they can sell another $40 million, which completes the $100 million auction. So what winds up happening? Okay, what winds up happening is the $20 million worth of non-competitive bids will be awarded. They will be filled. Then the $40 million worth of 4.9% bid will be awarded because they were willing to pay the highest price or take the lowest yield. But then they had to drop the price down or increase the yield to 5% to complete the auction. So those will be filled. And the $30 million that were looking to be purchased at a yield of 5.1% will not get filled. Okay, they will not get filled. So there's no fill for that last $30 million. Now, what price or what yield does everybody get? And this is important, that everybody gets the same yield. The highest yield of 5% that completed the auction is what all the bonds are awarded at. So everybody pays that price that gives them a 5% yield. Therefore, all bidders get a 5% yield. And that is sometimes what's called the clearing rate. The auction clears at 5%. Now let's look at an activity. If you go to your workbook, you'll see there's a question that asks you to read each characteristic and circle which type or types of treasury debt that characteristic applies to. Now, there could be more than one correct answer for each characteristic. You can pause and complete the workbook before continuing. So let's take a look at the answers. So, more than 10 years to maturity would be T-bonds. Interest is federally taxable. That would be T-bills, T-notes, and T-bonds. Which ones are sold at a weekly auction? That would be the T-bills. Which are discounted securities, issued at a discount, mature at face value? That would be the T-bills. Now, we also did say treasury strips, but again, the treasury strips are actually not even issued directly by the government. They decide to strip the T-notes and T-bonds. But the T-bills are actually issued by the government at a discount, mature at face value. The difference is your interest. Which ones have 2 to 10 years to maturity? That would be the T-notes. Which ones are issued in book entry form? That would be all three of them, T-bills, T-notes, and T-bonds. And which pay interest semi-annually? That would be the T-notes and the T-bonds. Let's take a look at another question. Which of these statements are true with regards to Treasury auctions? Okay, which are true? Again, there could be multiple right answers. Are non-competitive bids awarded first? Competitive bids determine price. Non-competitive bids submit quantity and price or yield, and the lowest accepted price or the highest yield clears the auction. Well, let's take a look. The first one, okay, notice is true. Okay, so non-competitive bids are awarded first. They sort of set them aside, then the competitive bids determine the price. So notice choice 2 is correct. Choice 3, non-competitive bids submit quantity and price or yield. That is not true. That's what the competitive bids do. And finally, 4, the lowest accepted price or the highest yield of the accepted yields clears the auction. And notice that is true. The lowest accepted price or the highest accepted yield clears the auction. Everybody is filled at that lowest price or highest yield that clears the auction. So those are the Treasury obligations, which are direct obligations of the U.S. government. There are then government agency securities. This is debt instruments issued and or guaranteed by federal agencies and government-sponsored enterprises, GSEs, government-sponsored enterprises. These are generally exempt from federal and state registration requirements the same way treasuries are. So the federal government does not have to file a registration statement with the SEC or with the states when they issue treasury bills or notes or bonds. The government agencies are usually exempt from those registration requirements also. Similar to treasuries, they are generally quoted as a percentage of par in 30 seconds of a point. So the price, for example, for a Ginnie Mae instrument might be 98-16, which means 98 and 16 30-seconds percent of its par value. The accrued interest is generally calculated more like a corporate or municipal, where it's based on 30 days in each month, rather than using actual number of days. And then it's also based on 360 days in a year. So they just, for corporates, munis, and here we see the government agencies, generally when they calculate accrued interest, just assume that each month has 30 days and that the year has 360 days. And similar to treasuries, they are generally issued in book entry form. In book entry form, meaning there's no physical certificate that's actually issued. Now, what type of government agencies are there? Well, there's government agencies involved in farming loans. There's government agencies involved in the mortgage arena that play an important role with mortgage-backed securities. First, the farming. This is generally done by the Federal Farm Credit Bank. They provide agricultural loans to farmers. Farmers have very seasonal demand for money, and the Federal Farm Credit Bank, part of the Federal Farm Credit System, steps in to help that by providing loans, to farmers. Now, the interest on this debt is generally subject to federal tax, but exempt from state and local taxes. So they issue bonds to raise money to provide financing to farmers. The bonds that they issued are subject to, the interest you receive is subject to federal taxes, but generally exempt from state and local taxes. The other important industry that they're involved in is the mortgage-backed arena. This is generally through one of the government agencies, either the Government National Mortgage Association, often referred to as Ginnie Mae, the Federal National Mortgage Association, often referred to as Fannie Mae, and the Federal Home Loan Mortgage Corporation, quite often called Freddie Mac. They issue mortgage-backed securities, and a common type of mortgage-backed security is what's called a pass-through security. The mortgage-backed pass-through certificates, what they do is the government agency or perhaps a bank does it and then gets it guaranteed by the government agency. They pool mortgages together. So they buy up a lot of mortgages, or the bank or savings and loan might make the mortgages. These mortgages get pooled together. Then they sell interest in that mortgage pool. And a basic type of mortgage-backed security that was created was what was called the pass-through certificate. So we pool together mortgages. We sell interest in that pool. The investors own an undivided interest in this pool of mortgages. Then the homeowners pay interest and principal to a bank that's servicing the loan. That servicing bank keeps a fee for servicing the loan and forwards the remainder to the pool. What will the pool do? Well, if you bought into that pool, you will receive monthly payments from that mortgage-backed pass-through. And if you've ever made mortgage payments, what does each payment represent? Interest and principal. Interest and principal. So what they're doing is basically passing through the mortgage payments that the homeowners are making. How often will you get payments? Monthly. And those monthly payments consist of interest and principal. The interest portion you could see is fully taxed. You might want to note that, what do we mean by that? Federal, state, and local. It's subject to federal, state, and local taxes. So it's not exempt from any of the taxes. And an added risk in these mortgage-backed securities is, notice here it says they're subject to prepayment risk. What is prepayment risk? It's the risk that you might get the principal paid back to you quicker than originally projected. Why? Because homeowners can prepay their mortgages whenever they want. And remember, they're passing through the payments. And homeowners prepay their mortgages for a couple of reasons. One is because they move. So they sell the house, they pay off that loan, and if they buy a new house, they take out a new mortgage for the new house. So that's one reason the mortgage might get paid off early, is because the homeowner moves. But the other bigger reason that we care about is because interest rates fell and the homeowners can take advantage of refinancing their mortgage. Picture if you took out a mortgage at 6%. So you're paying 6% a year, fixed rate. What happens? Mortgage rates fall to 4%, and you plan on living in that house for a long time. Well, why would you continue to pay 6%? You would not. You would take out a new mortgage at 4% and pay off your 6% loan because you're allowed to do it. So you would borrow money at 4% and pay off your entire 6% mortgage. That's called a refinancing. Well, what happens to the person who bought into that pool where that 6% mortgage was sitting? Well, the homeowner just paid off the whole 6% loan. So part of that mortgage is in that pool. Now, we pooled together a bunch of mortgages, but notice the prepayments in that pool now might be faster than we originally projected. And by the way, notice if rates fall, prepayments speed up, and you'll be prepaid at a time when interest rates have fallen. So now you could take that money and reinvest it probably at lower rates than you were originally getting. Well, they have this added prepayment risk. So why do people buy these instead of treasuries? They have a bit higher yield generally than treasuries. So notice the pass-throughs generally provide a slightly higher yield than the comparable treasuries. That's sometimes called a yield pickup, that you'll pick up a little bit more yield by buying the mortgage-backed pass-through than you would by buying the treasuries. Now, for the government agency mortgage-backed securities, they're guaranteed by the government agency, Ginnie Mae, Fannie Mae, or Freddie Mac. Ginnie Mae is actually a government guarantee. Fannie Mae and Freddie Mac are guaranteed by that government agency. It's not technically a government guarantee for test purposes, okay, although it is still very high credit quality, where Ginnie Mae is actually guaranteed by the government. Only certain types of mortgages go into the Ginnie Mae pools. Now, let's take a look at an activity. Go to your workbook and complete the agency securities activity. Read each statement and fill in the blanks. And again, you can pause. Okay, let's look at the questions. Although agency securities are not direct obligations of the U.S. government, their credit risk is still considered low. Okay, the credit risk, or in other words, the credit worthiness is very high, very low credit risk. Agency securities are blank from state and federal registration. They are exempt from state and federal registration. You don't have to file a registration statement with the SEC or the states to issue the Ginnie Mae or Fannie Mae or Freddie Mac or Federal Farm Credit Bank securities. The Federal Farm Credit Bank is an example of a government-sponsored enterprise or non-mortgage-backed entity. Ginnie Mae, Fannie Mae, and Freddie Mac are examples of mortgage-backed securities. They're government agencies that are involved in the mortgage arena, and they issue mortgage-backed securities. Mortgage-backed securities represent an interest in a pool of mortgages. So they pool together generally similar fixed-rate mortgages into a pool and sell interest in that pool to investors. Blank is unique to mortgage-backed securities, and what we're looking for there is prepayment risk. Okay, if interest rates fall, homeowners are allowed to refinance and pay off their loans, and you might get prepayments faster than what was projected. Agency blank provide excellent credit quality and a slightly higher yield than treasuries. Okay, agency pass-throughs, they are excellent credit quality if it's an agency pass-through with a slightly higher yield than a treasury. Now, in the real world, there are mortgage-backed securities that might not be guaranteed by an agency. Then you would have to look at the creditworthiness of the mortgages in that mortgage pool if it wasn't guaranteed by a government agency. However, the ones presented on the exam will be government agency pass-throughs, which are guaranteed by the government agency and therefore have higher credit quality or a small amount of credit risk. Now let's turn our attention to municipal bonds. And who issues municipal bonds? Well, municipal bonds are issued by states and political subdivisions. They're issued by public agencies and authorities that are created by the municipalities. And they're issued by territories of the United States. So who are the states and political subdivisions? Things like cities, counties, towns, school districts. They issue bonds along with the states. And quite often they will issue general obligation bonds, we're going to see. We also have agencies and authorities that are created by the municipalities. Okay, they issue bonds. This is sometimes to finance transit systems, housing authorities, water systems, electric systems. So these are often issued by the agencies and authorities that are created by the municipalities, and quite often what they're issuing is revenue bonds. Then we have territories, and some of those include Puerto Rico, Guam, the U.S. Virgin Islands. So they will issue bonds backed by the full faith and credit and taxing power of that territory of the United States. Now, one important distinction with these territories is their bonds are triple tax-free automatically, meaning they're exempt from federal, state, and local taxes. They're exempt from federal, state, and local taxes, sometimes called triple tax-free. Now let's take a closer look at the types of municipal bonds. There's two major types of municipal bonds. There's general obligation bonds, quite often referred to as GOs, and there's revenue bonds. Let's take them one at a time. GOs, general obligation bonds, are issued by the state, cities, counties, towns, school districts, and they're issued for general purposes to meet really a wide array of different needs of the municipality. But the big thing is, what are they backed by? They're backed by the full faith, credit, and very importantly, the taxing power of the municipality. They're backed by the full faith, credit, and taxing power of the municipality. Well, what taxing power does the municipality generally have? States generally collect a lot of money from sales tax and income taxes. Now, I realize that many of you might live in a state that doesn't have a sales tax or an income tax, but many states do have sales taxes and income taxes, so it would be a right answer on the exam. One of the things backing the state general obligation bonds, since it's backed by their full faith, credit, and taxing power, is the taxes that they often collect, such as sales and income taxes. Where the local governments generally do not collect a lot of sales tax or income tax. Most municipalities don't have an extra sales tax and income tax. Where do the local municipalities collect a lot of their money? From property taxes. This is sometimes referred to as an ad valorem tax, which is Latin for based on or according to value. And your property has an assessed value. They multiply that by the tax rate, which is sometimes referred to as a millage rate, and that will give you the tax. 1 mil equals 0.001. So if you had property with a market value of $200,000, but an assessed value of $150,000, and a tax rate of 9 mils, you would take the assessed value of $150,000, not the market value of $200, but it's the assessed value, let's say $150, times the tax rate, which is 9 mils, but 9 mils is 0.009. So it would be 150,000 times 0.009, and that would give you your tax bill. And local municipalities might also collect money from things like parking and licensing fees. Now, revenue bonds are not backed by full faith, credit, and taxing power of a municipality. Instead, it's backed by specific revenue-producing facilities. So this is used more to finance a specific project, such as a toll road, a bridge, a tunnel. And what is it backed by? It's backed by the revenue produced by the things that authority operates. So you go over the bridge, you pay a toll. That is one of the things that are paying off the bonds. Okay, or the main thing paying off the bonds is the revenue produced by that facility, the toll from going over that bridge or highway. Sports stadiums might be financed this way. Airports might be financed this way. Water systems financed this way, backed by your water bills. The big thing to know with revenue bonds is it's not backed by taxes. It's not backed by the full faith, credit, and taxing power of the municipality. Instead, it's backed by the revenue produced by the specific facilities. And if that revenue is not sufficient, then these bonds could default. Okay, now even general obligation bonds obviously could default because the municipality can default, but GOs are considered generally to have a higher credit rating than revenue bonds. Revenue bonds generally are said to entail a bit more risk because it's backed just by the revenue produced by the facilities, and if that revenue is not sufficient, then the bonds would default. And again, these are often issued by authorities or agencies that are created by the municipalities. Now, revenue bonds, notice, are not backed by taxes, so they're sometimes referred to as self-supporting debt. This debt will support itself because the debt is backed with the revenue produced by the facility that it's being used to finance. And because it's not backed by taxes, revenue bonds do not require voter approval to be issued because it's not backed by your taxes. Where general obligation bonds will generally require voter approval because it is backed by your taxes. Now, for revenue bonds, what they will often have is what's called a feasibility study. A feasibility study. The feasibility study looks at whether the project is feasible, let's say to build this bridge, what it would cost. Okay, to build it, part of it contains an engineer's report. So revenue bonds will generally have a feasibility study before they're issued, where GO bonds, since they're backed by your taxes, generally require voter approval. Now, let's take a look at a little activity. If you look at your workbook and complete the municipal bonds practice activity by filling in the table. Let's take a look at that table that's in your workbook. GO bonds versus revenue bonds. What's the purpose of why they're done? What are they really backed by? What's the sources for the payment? Which one entails more risk? Which one entails less risk? Which one would have a higher yield? Which one would have a lower yield? Which one requires voter approval? And are they subject to debt limitations, which I'll explain at the end. Again, you may pause it to fill in your answers first. Okay, let's take a look at the answers. The purpose of why they're issued. General obligation bonds are more general purpose, where revenue bonds are specific revenue producing facilities for the bridge, for the airport, okay, for the sports stadium, what have you. What are they backed by? The sources of payments? GOs, the full faith, credit, and taxing power of the municipality, where revenue bonds is the revenue produced by the facilities. Which ones entail more risk? Which ones less? GOs have less risk. Revenue bonds have more risk. So what about the yield? I didn't specifically say that. Which would have a higher yield? Which would have a lower yield? GOs would have a lower yield because they have less risk, where the revenue bonds would have a higher yield generally. Which ones require voter approval? The general obligation bonds do, not the revenue bonds. But again, revenue bonds often will have what's called a feasibility study. And which one is subject to debt limitations? Only the ones that are backed by your taxes. So that's the general obligation bonds are subject to debt limits, not the revenue bonds. Okay, not the revenue bonds are not subject to debt limits. Debt limits are a maximum amount of debt that the municipality can take on. Again, only the ones that are backed by your taxes, GO bonds, are subject to those debt limits. Now, let's take a closer look at types of revenue bonds. Here we could see that revenue bonds might be used to finance an awful lot of different things. And there's some bonds that are a little bit different than a pure revenue bond. So let's take a look at all these different types of revenue bonds. And we list them all as just different types of revenue bonds because the way the Municipal Securities Rulemaking Board generally looks at municipal bonds is GO bonds are backed by the full faith, credit, and taxing power of the municipality. Anything that's not that, they say, is a type of revenue bond. So transportation revenue bonds, generally backed by user tolls, user fees. They're also used to finance things like train systems and subway systems. Special tax bonds are backed by one specific tax. So a good example might be that it's backed by gasoline tax that the state collects, or tobacco tax, or an extra excise tax that they have on alcohol. So a municipality might issue bonds to repair roads within the municipality, and what they're going to use to pay off the bonds is the gasoline excise tax that the state has. So it might be a type of what we call special tax bond, backed by a specific tax, like a gasoline tax. Special assessment bonds are backed by a one-time fee, sometimes referred to as an assessment, charged to those who benefit from a project. This is sometimes done when towns first put in sidewalks or sewer systems. They might issue bonds to, let's say, put in a sewer system. Then they charge each property owner an assessment or this fee to connect to the sewer system, and it's that assessment that's backing the bonds. So it's backed by this special assessment for connecting to the sewer system. The term double-barreled bond means backed by two sources. And the way these generally work is it's backed by the revenue produced by a facility. So the municipality might issue revenue bonds where it's backed by the revenue produced by the facility to build this new convention conference center, and it's hoped that the revenue will be sufficient. But if it's not, they double-barreled it, which means it's also a general obligation pledge of theirs. So if the revenue isn't sufficient, it's also backed by the full faith and credit of the municipality. Now, don't confuse that with a moral obligation bond, where when it's a moral obligation bond, if the revenue is insufficient, so again, it's a revenue bond backed by revenue, but then what the state legislature has said is if the revenue isn't sufficient, we will vote to appropriate the funds as needed. So if the revenue is insufficient, the state legislature is morally but not legally obligated for the shortfall. So they didn't say it was double-barreled. They said we will vote to appropriate funds as needed. So they took on a moral obligation to appropriate those funds, but not a legal obligation. Private activity bonds are a bond generally in which more than 10% of the proceeds will benefit a private entity rather than really for public use. And related to that, to an extent, are industrial development bonds. They're issued by a municipality, but to build a facility for a corporate user. And the way they work is the municipality or the authority created by the municipality leases the facility to the corporate user, and it's the lease payment from the corporation that's backing the bonds. And usually that's all they're pledging to back the bonds is the payment from the corporate user. So the credit of an industrial development bond is generally based on the credit of the corporation, not the municipality. It's based on the credit of the corporation, not the municipality. So those are the different types of municipal bonds. Then we have municipal notes. Municipal notes are shorter term municipals, generally a year or less. Okay, although you do see longer term notes than that occasionally, but generally a year or less. And the type of notes that you might see on your exam are what are called tax anticipation notes, revenue anticipation notes, bond anticipation notes, and grant anticipation notes. These anticipation notes are issued, they're short-term municipal debt, issued in anticipation of some future event that will be used to pay off the notes, that will provide the money to pay off the notes. And these are tax-free, since they're municipals, so they're federally tax-free. And TANs, or tax anticipation notes, are issued in anticipation of future tax receipts that the municipality will collect. Revenue anticipation notes in anticipation of some future revenue that the municipality will receive. Bond anticipation notes in anticipation of a future long-term bond issue that the municipality will make. And when they issue the bonds, they'll take all or part of those proceeds and use them to retire the notes. And grant anticipation notes, which are in anticipation of usually a federal grant to the municipality. Now, the important thing to note is that these notes are short-term municipals, okay, generally a year or less. The ratings for these notes are a little bit different than the bond ratings that you looked at in Chapter 4. S&P has ratings for the notes SP1 plus, SP1, SP2, SP3, where Moody's has ratings that are MIG ratings, MIG 1 through MIG 3, and then an SG. SP1 plus is very strong, SP1 is strong, SP2 is satisfactory, SP3 is speculative. On the Moody's side, MIG 1 is superior, MIG 2 is strong, MIG 3 is acceptable, SG means speculative grade. What I might watch out for on the test is make sure you know that MIG ratings would be for municipal notes, and MIG 1 through MIG 3 are all investment grade. MIG 1 through MIG 3 are all investment grade. In fact, the IG stands for investment grade. And know that 1 is better than 2, which is better than 3. Now, how do the municipal bonds get from the issuer, the state, cities, counties, towns, into the investor's hands? This is what's called the underwriting process. So 1, what's the role of the underwriter? So the municipality might use either a competitive bidding process or a negotiated process, select investment bankers, and the underwriter acts as a link between the issuer and the investors. So they're basically getting the bonds from the issuer, the states and cities, into the investor's hands. They assist the issuer in pricing the securities, structuring the financing, preparing the disclosure documents. And the disclosure document for municipal deals is not technically called a prospectus. The document that replaces the prospectus is what's called an official statement. The official statement is similar to a prospectus, but the official statement actually does not have to be prepared by a municipality. Now, for most big municipal deals, they do, but it's technically not required. Why? Because municipal bonds are exempt from the registration requirements of the 1933 Act. So the municipalities do not have to file a registration statement with the SEC. They don't have to prepare a prospectus. But quite often they do prepare a disclosure document for investors, or else it may be difficult to find investors willing to invest if you don't have some disclosure document. That disclosure document is referred to as an official statement. The second box, the underwriting process. Although exempt, the underwriting process for municipals is very similar to a lot of corporate deals. How do they select an underwriter? It might be through a negotiated method or a competitive method. With a negotiated method of underwriting, the issuer, let's say the state or city, will select investment bankers to work with. So they're not opening it up to competitive bidding, although they may interview several different banks, and they will select underwriters to work with. Then they will negotiate the terms of the offering. So they mutually agree on the coupons that will be put on the bonds. Are these going to be 2%, 3%, 4%? The price that the underwriters will buy the bonds from the issuer at. Then the underwriters hope to sell it at a slightly higher price to make money. But this will be negotiated between the issuer and the underwriters. With competitive methods of underwriting, the way it works is the issuer invites underwriters to submit sealed bids. And the best bid, the one that provides the issuer with the lowest cost over the life of those bonds, wins the bid. So with competitive bids, they publish what's called a notice of sale, and the different banks will submit sealed bids, and they say, hey, we'll underwrite the bonds, we'll pay you this price for the bonds, and you put these coupons on the bonds, and we'll underwrite them. And what happens is whoever submits the best bid wins. And forming the syndicate, a syndicate is formed. Why? What is a syndicate? Why is it formed? A syndicate is a group of broker-dealers that get together to underwrite an issue. It's a group of broker-dealers that get together to underwrite an issue. Now, why do they form syndicates? Well, for two reasons. One, to share the liability. So, on a big deal, it might be a lot of liability for one broker-dealer or bank to take on themselves. So they might join together with 8 other brokerage firms, form this syndicate to spread out the risk. And the other thing is, there's more firms trying to sell the deal. So it also enables for more firms to try to place or sell the bonds. The agreement between the broker-dealers is laid out in what's sometimes called a syndicate agreement or a syndicate letter. Okay, a syndicate agreement or a syndicate letter. It's the agreement between the broker-dealers that make up the syndicate. So maybe these 7, 6, 10 different brokerage firms that got together to do this underwriting. And that syndicate letter will address the size and type of offering, the percentage required for each participant, for each broker-dealer that's a member of the syndicate, how they're going to split up any unsold bonds. It's outlined in this syndicate letter, okay, or syndicate agreement, or sometimes even referred to as an agreement among underwriters, an agreement among underwriters. Now, municipal deals are generally done on what we call a firm commitment basis. What that means is the syndicate is committing to this underwriting, and whatever can't be sold by the syndicate will be retained by the syndicate, by those broker-dealers, and the syndicate letter will say how they're going to split up those unsold bonds. Now let's take a quick look at a question. Again, feel free to pause it. Which of these statements are true with regards to underwritings? And again, circle all that apply in the workbook. More than one can be true. Feel free to pause. Okay, let's take a look. So, Roman numeral 1, syndicates are created so that multiple firms share in the liability of the bond offering. Is that true? The answer is yes, it is. That is a true statement. Number 2, voter approval is normally required when issuing GO bonds. Is that true? The answer is yes, that is true. Okay, since GOs are backed by taxes, that's a true statement. It generally requires voter approval. Roman numeral 3, feasibility studies are used when issuing revenue bonds. Is that statement true? The answer is yes. The revenue bonds don't require voter approval, but they do generally have a feasibility study. And Roman numeral 4, the issuer and the underwriter work out the offering terms in a competitive sale. Is that one true? No, that's a better description of a negotiated sale rather than a competitive sale. So negotiated, the issuer and the underwriter work out the offering terms. In competitive, it was a competitive bidding process. So our true statements are 1, 2, and 3. Syndicates are created so that multiple firms share the liability. Voter approval is normally required for GOs, and the feasibility studies are required for revenue issues. Now, before we leave municipal bonds, let me address one more important aspect of municipal bonds, mentioned in other places in the material, and that is that one of the big reasons for buying municipal bonds is that the interest income on a municipal bond is exempt from federal taxes. The interest income on a municipal bond is exempt from federal taxes. And investors actually will accept a lower yield on a municipal bond because of that tax exemption on municipal bonds. So municipal bonds, remember, are exempt. The interest is exempt from federal taxes. So if you're in a high tax bracket, municipal bonds might be attractive, even though they have a lower yield than a similar quality taxable bond. If you're in a high tax bracket, the fact that you don't have to pay federal tax on that interest may make the municipal bond more attractive than, let's say, the taxable corporate bond. Now, the municipal bond interest, is it exempt from your state and local taxes? The answer to that is maybe. It usually depends on whether you bought one from the state in which you lived. If you buy a municipal from your own state, your state will probably exempt it from state and local taxes. But if you bought a municipal from a different state, you will have to probably pay taxes to your state on that interest. And now let's turn our attention to corporate bonds. Corporate bonds are issued by corporations. So IBM, Disney, they issue bonds. Remember that the bond holders are not owners of the corporation, they are creditors of the corporation. So it means they are owed money. To the corporation, that bond represents debt. It's a debt obligation of that corporation. And these could be issued for many purposes, from building facilities to buying equipment, expanding their business. So they can raise money, corporations, by borrowing the money through the issuance of bonds. The advantage is that the corporation is not giving up ownership in the corporation. Remember, the bondholders are just creditors. They are simply owed money. The disadvantage is that the corporation is required to repay that money, plus the interest. So they're making the interest payments, then eventually they have to repay that face amount or principal amount, or they've defaulted and can be forced into bankruptcy protection. Although buying corporate bonds puts an investor's capital at less risk than purchasing stock of the same company, bonds typically don't offer the same opportunity for growth, for capital appreciation, as common stock does. So if you buy a bond, you might be getting a 6% yield, and you're getting this consistent 6%. Also, you will be paid back par value at maturity. So you're not going to, if you hold it to maturity, you know you'll get paid back par value. And if they do default, you come in the pecking order higher than the stockholders. So your capital is at less risk. Then why does anybody buy stock? Well, because stock represents ownership in the company. And if the company does well, you share in those profits, and the stock will go up, and you'll have a much higher growth rate potential in stock than you will in bonds. Now, when it comes to corporate bonds, there's two major classifications. They're divided into two major groups. Some bonds are secured and some bonds are unsecured. Secured versus unsecured. Although the debt issued by corporations is backed by the corporation's full faith and credit, secured bonds, the corporation has pledged specific assets to back the bonds. So if the corporation defaults, the bondholders have a claim against some specific asset. And we'll look at different types of secured debt in a second. Unsecured debt is backed by the corporation's full faith credit, so their earnings ability, but there's no specific asset that you have a lien against. Sometimes referred to more as just a general creditor of that corporation. There's no specific asset that's been pledged that you have a lien against. Now, unsecured bonds are sometimes called debentures. Unsecured bonds are sometimes called debentures. Well, what could bonds be secured by? There's mortgage bonds. There's equipment trust certificates. There's collateral trust bonds. Let's take them one at a time. With mortgage bonds, the bondholders have a lien on some property. So a corporation might issue bonds where if they default, bondholders have a lien against the building. So if the corporation defaults, it was secured by that building that was pledged. And that would add creditworthiness to the bond. Equipment trust certificates are backed by some equipment that's owned by the company. Generally, if there's a default, the trustee, who's there for the protection of the bondholders, has title to that equipment. And if the company goes under, they could release that equipment or resell that equipment. So it's backed by something of value. This is sometimes referred to as rolling stock. And the equipment that it's often backed by is equipment that moves, planes, trains, trucks. So if there's a default, the trust takes over the plane, they can release that plane to another airline. So it's backed by some equipment such as a plane or a train. And the third one, the collateral trust bonds, backed by securities of another company. Backed by securities of another company. So if there's a default, you have a claim against securities being held as collateral in another entity. This might be securities that they owned, or sometimes it's a parent company to a subsidiary. And you would have a claim against the stock or bonds being held as collateral if there is a default. So these are three different types of secured corporate debt. We then have unsecured corporate debt, where it's backed by the corporation's full faith and credit, but there's no specific asset that's pledged, and this is called a debenture. Notice, a debenture, so they are referred to as debentures, and you don't have a claim against any specific asset. Now, sometimes a company might issue debentures that come after the regular debentures. These are what are sometimes referred to as subordinated debentures. So they would have a secondary claim or a junior claim to the regular unsecured debentures. Now, in case of a default of the subordinated debentures, the owner's claims would be subordinate to those of the other bondholders. But remember, bondholders, types of creditors come before owners. Now let's take a look at the liquidation proceedings. What if a corporation goes bankrupt and is being liquidated? What is the order of payments? Well, first come the secured creditors. Remember that they have a lien against some specific asset. So maybe the bonds are backed by a building, and if the company is being liquidated, the secured creditors would have a claim against the value of that building. Next come the administrative expenses or administrative claims. Here, there are costs involved in operating the business and winding down the business while it's being liquidated. Nobody would work for a business if they weren't going to get paid. So the administrative expenses, this includes the current wages of the employees, it includes the attorney fees, the accounting fees, the trustee fees. It may also include taxes. So next would come these administrative expense claims. Then come the general creditors. Now, another term that the test might use is the unsecured creditors. Unsecured creditors or general creditors. Know that a type of debt instrument that is unsecured is a debenture. So here they might say debentures. You need to know that they are unsecured creditors. Then come subordinated unsecured creditors. This may be subordinated debentures. Subordinated means comes after. So the more senior debentures would get payment before the subordinated debentures. But again, after the secured creditors, because there it was secured by some specific asset. Remember that all creditors come before any equity holders. So after the subordinated unsecured creditors, the subordinated debentures, then would come equity holders. What's the pecking order there? Make sure you know first preferred stockholders. Preferred stockholders are preferred over common as to two things, dividends, and here we see liquidation. Then finally, the common stockholders would get paid. Some other types of corporate bonds. We have income bonds, Eurodollar bonds, Yankee bonds, a more general term, Euro bonds. Income bonds are a strange type of bond. They are sometimes issued by companies that are coming out of bankruptcy in a corporate reorganization, perhaps coming out of a bankruptcy. And what makes income bonds very different than other types of bonds is the interest is payable only if the income is sufficient. So the issuer promises to repay the principal at maturity, but the interest is generally payable only if the income is sufficient. If they don't have sufficient income, they could generally miss payments on their income bonds. So the interest is payable if the income is sufficient, but if they don't have sufficient income, they could perhaps miss interest payments. Eurodollar bonds pay their principal and interest in US dollars, but they're issued outside the US. Quite often in Europe, but it doesn't have to be. So they pay interest and principal in US dollars, but they're issued outside the US. They could be issued by U.S. companies or foreign companies, quite often multinational companies, sometimes international agencies such as the World Bank. They issue bonds maybe throughout Europe, but it pays interest and principal in U.S. dollars. And if they're issuing the bonds outside the U.S., it generally avoids registration with the SEC. So they're generally exempt from having to register with the SEC if you're issuing it outside the U.S. And they can come back and trade in the U.S. usually after a 40-day period, okay, where they have to be issued outside the U.S. You will see euro-dollar bonds come back into the U.S. markets in the secondary market. Now, Yankee bonds allow foreign entities to issue bonds here in the U.S. Since they're selling it in the U.S., these do have to be registered with the SEC. So this is a foreign entity that's issuing bonds in the U.S., sometimes referred to as Yankee bonds. Then there's a general term called Euro bonds, which means that bonds are being sold in a country that's different than the currency that's used to pay the interest and principal. So it's sold in one country, but denominated in the currency of another country. Now, the issuer, the currency, and the primary market that it's issued in might all be different. So we might have a Japanese issuer issuing euro-denominated bonds in South America. An example of a euro bond is actually a euro-dollar bond. It's sold in one country but denominated in a different currency, right? U.S. dollar-denominated bonds issued outside the U.S. But a general term is euro bonds. We have euro-yen bonds, which are yen-denominated bonds issued outside of Japan, for example. Now, let's take a look at a question again. Feel free to pause. Take a minute to answer the following question. Which of these statements are true with regard to corporate bonds? Again, you could circle all that apply. Which of these statements are true with regard to corporate bonds? Feel free to pause. Okay, so let's look at the statements one by one and ask ourselves, is it true? Okay, statement number one. Buying corporate bonds puts an investor's capital at less risk than purchasing stock. Would that be true? Buying corporate bonds puts your capital at less risk than buying stock. That would be true. Okay, you will be repaid par value at maturity. Bonds generally don't fluctuate as much in price. If the company goes under, you are higher in the liquidation proceedings. Statement two. With a corporate bond, the corporation gives up control as well as a portion of the profits. No, that is what they give up with stock, so that would not be true. 3. Interest must be paid on bonds before dividends are paid on stock. Is that true? Yes. Bondholders have priority over stockholders. You can't pay dividends if you miss your interest payments. In statement 4, the corporation is required to repay the money that was borrowed plus interest. That is true. Okay, if you've ever taken out a loan, you pay interest, and then eventually you have to repay the principal. So that would be a true statement. So our true statements are 1, 3, and 4. Buying corporate bonds puts the investor's capital at less risk than stock. Interest must be paid on bonds before dividends for stock, and the corporation is required to repay the money that was borrowed plus interest. Let's take a look at another activity. In the workbook, you can match each description to the appropriate term. So here we see the question in the workbook. So there's income bonds, euro-dollar bonds, Yankee bonds, unsecured debt, collateral trust bonds. Match them to the description. Again, feel free to pause. Let's take a look. Income bonds, Okay, are a weird type of bond in that the interest is payable if the income is sufficient. But if they don't have sufficient income, they can miss the payments on their income bonds. Eurodollar bonds. Which one did we match with Eurodollar bonds? Bonds issued outside the U.S. but pays the debt service. Remember, debt service is payment of interest and principal in U.S. dollars. What did we go with for the Yankee bond? The bond is issued in the U.S. by a foreign entity. Unsecured debt is a corporate bond backed by the corporation's full faith and credit, but there's no specific asset that's been pledged, sometimes referred to as a debenture. Okay, as a debenture. And the collateral trust bonds are secured by the securities of another company, okay, or another issuer. And the last type of securities, the money market instruments. Money market instruments are short-term instruments, okay, short-term instruments. So they're short-term debt, generally a year or less. They are generally considered very credit-worthy, and they're generally considered liquid, meaning the ability to get out of it at a reasonable price quickly. And the money market instruments are a good place to park your money for the short-term basis. Maybe I needed to buy a house in a few months, or I sold stock and I don't know what to invest it in right now, so where does the money sit in the interim? In money market instruments. So it's suitable for investors who seek safety when intending to make a purchase in the near future or while evaluating different investment options. Where do I sort of park that money in the interim? In money market instruments. And when we look at investment companies, it might be in a money market fund, which invest in money market instruments. Now, what are some of the types of money market instruments? There's T-bills, which we covered, which was short-term treasury debt. Bankers' acceptances. A banker's acceptance is a short-term instrument that's generally created by foreign trade, by import-export operations. And you could almost think of it like a post-dated check from an importer to an exporter that's been accepted by a bank for payment at a future date, let's say in 90 days. The bank will honor this for its face amount. It then trades in the secondary market at a bit of a discount to that face amount, the difference being the buyer's interest. The big thing I want you to know is just that a banker's acceptance is a money market instrument. It's a short-term debt instrument. And I probably would know, often created by foreign trade. Commercial paper is a short-term unsecured obligation of a corporation. And these generally have a maximum maturity of 270 days so that they can be exempt from the registration requirements of the 33 Act. So generally a maximum maturity of 270 days. So it's short-term corporate debt, max maturity of 270 days. Negotiable certificates of deposit. These are short-term obligations of banks. Now, some people say to us, I've put less than $100,000 in a CD. Here we see the minimum denomination is $100,000. This is for negotiable CDs. Negotiable means it trades in the secondary market. It can trade in the secondary market. The FDIC insurance generally goes up to $250,000. And repurchase agreements, sometimes referred to as repos. This is when a dealer sells securities to another dealer, but with the agreement to buy it back quickly at a slightly higher price. So with an agreement to repurchase, generally quickly, there's overnight repos, 7-day repos. I'll sell it to you, I'll buy it back tomorrow at a slightly higher price. The difference is your interest. Let's take a look at an activity. Match each description to the appropriate term. So banker's acceptance, repo, CD, commercial paper, T-bill. Again, feel free to pause. So the banker's acceptance, remember, that was created by foreign trade. The repo, remember, involves two transactions. The dealer sells the securities with the agreement to buy it back quickly at an agreed upon price, a little bit higher, the difference being the interest. CDs. CDs, remember, are unsecured obligations of banks, where commercial paper, an unsecured corporate debt. And a T-bill is treasury debt. Now, what's next? In the next chapter, chapter 6, we'll look at investment returns. In chapter 4, we started to look at bond yields. In chapter 6, we'll get further into bond yields and get more in depth and have additional understanding, which is a little bit more complex than the yields we looked at in chapter 4. We'll also look at the returns from stock, which is dividends, and we'll also talk about the appreciation of securities being part of the return. That concludes chapter 5.